High yield stocks are a great way to compound wealth over the long term for several reasons. One of them is simply due to the fact that you get that high yield, and if it's backed by a stable business model that generates cash flows that are highly predictable through all sorts of macroeconomic environments, you get that distribution coming in regularly, and so you have that good baseline return. That takes a lot of the speculation out of the valuation analysis because you're not having to wonder if can they sustain a 10%, 20%, 30% growth rate 5-10 years into the future that some of these really richly valued growth companies require. You just need to look at, is the dividend sustainable over time? And then just maybe add on a little bit of growth on top of that, and you've got a great investment. So that is one reason why high yield stocks are such a great investment. I also like them because as a result of that lower speculation, they're easier to value, and therefore you know better whether it's fully or even overvalued versus undervalued. And then you can use an opportunistic capital recycling program to sell businesses that are fairly or overvalued and take the capital and put it into undervalued businesses. Of course, when you're dealing with high yields, you sometimes also have to deal with higher risk, especially if the yield is in the double-digit range, because that typically means that the market is pricing in a cut to the dividend at some point in the future, or at the very least, little to no growth and a potential risk to the dividend. So you need to be extra careful when investing in higher yield stocks. I don't completely avoid the space, but I'm generally very careful when investing in it. And so today I'm going to invest 3 of these double-digit yielding stocks, 2 that I personally view as a buy right now, and 1 that I view as a sell. Okay, before I get into these stocks, though, if you could please give this video a like, it'd greatly help in its distribution. Thank you very much. Okay, so what is the first stock that I would buy of the 3 I'm going to talk about today? That's Golub BDC. Now, Golub BDC is a business development company, as its name implies. Its ticker symbol GBDC. It has about an 11% dividend yield right now if you include the special dividends it's been paying. On the base dividend level, it's around 10%. And it covers its base dividend by over 20% with its net investment income. That makes it pretty well covered, especially when you consider the fact that the vast majority of its portfolio, 90-something% of it, is in first lien senior secured loans, a couple percentage points in second lien as well, and then you have some in equity and preferred equity as well. And so these high in the capital stack debt investments give it a very stable cash flow profile, make it a little bit more defensive in the event that we go into an economic downturn. Now, of course, these loans are primarily floating rate. In fact, they're almost entirely floating rate. And they're indexed to short-term interest rates. So when the Fed is cutting rates, which it has been doing, its net investment income does decline some. Now, some of its debt that on its liability side of its balance sheet is also floating rate. So there is some offset there, although it's still weighted towards profiting from rates rising and seeing its income decline when rates fall. But it has that nice 20-something% buffer that should enable it to be able to support its base dividend, even if the Fed does continue to cut rates for the foreseeable future. On top of that, it has an investment-grade balance sheet with relatively low leverage. And in fact, it has a positive rating from Moody's. And if Moody's does end up upgrading it, it will have the highest Moody's credit rating in the entire publicly traded BDC space, which would be quite notable. On top of that, it has a strong underwriting track record. It's had low non-accruals pretty consistently over the years. Management has consistently sustained or even grown its book value per share while still paying out that really hefty dividend. Meanwhile, it's sustained its dividend and even grown it over time. And perhaps what I like best of all about GBDC is that on top of its quality underwriting, its defensively positioned portfolio, management's strong track record, it has one of the lowest fees in the entire externally managed BDC space, both on a base management fee level as well as its incentive fee structuring. And so you get really good management and a good portfolio at a low cost. Count me in. And last but not least, it currently trades roughly in line, actually a slight discount to its net asset value, which I think is a compelling value when you consider other BDCs of similar quality trade anywhere from 10 to 20% premiums to net asset value. And so there, in fact, GBDC has traded at a premium, so it's net asset value in not too distant past. And so when you factor in all those things, I think GBDC offers at a minimum a nice 10, 11% annualized return just from the dividend. But then you also have some growth potential, albeit very small, but also valuation multiple expansion potential if it were to reprice to be in line with many of its peers. And so I think a GBDC is one high yield, double-digit yielding stock that I think is worth buying right now. Another one that I like is Delek Logistics Partners, and its ticker symbol DKL. Now, before I get into discussing this one, if you could please subscribe to my channel, that would really help me grow my audience. I'd be greatly appreciative. Thank you very much. Okay, now what is DKL? It is a master limited partnership. It invests in midstream energy. Now, it does issue a K-1 tax form, so be mindful of that. If you invest and you have an issue with K-1s, this may not be for you. Now, you can invest in Delek U.S. Holdings, which is a refining company, but they also have a large position in DKL. In fact, they own the majority of DKL units. And so that's a company that still has a very attractive dividend yield of about 6%. That does give you exposure, significant exposure to DKL, and actually at a discounted valuation. Plus you get a 1099 tax form. Maybe I'll discuss that one in another video. So again, subscribe if you want to check out that video when it comes out. But for now, we're going to talk about DKL because its dividend yield is over 11%. And so if you're looking for that big, juicy yield, DKL is the way to go here. And it covers its distribution by over 30%. So it's got a nice buffer to cover that distribution. Meanwhile, it's been working hard to reduce its leverage. It's gotten its leverage ratio well below 3.8 times now. And so its leverage is on a much more sustainable footing. And its business is quite strong. It has some high quality assets with long dated contracts. In fact, it recently just did an amend and extend deal with Delek U.S. Holdings, a ticker symbol DK that I just mentioned, to extend its contracts further to give it greater cash flow visibility. And it's also just got a Wink to Webster pipeline asset from DK as well that further enhances its cash flow profile, the quality of its business model. So that further strengthens the outlook for DKL. And of course, the other thing to keep in mind with DKL is that it's been growing its distribution very consistently. So you get that big yield of about 11.5% that's well covered by distributable cash flow, has stable defensive cash flows coming in from its long dated contracted assets. It has a much improved balance sheet that takes a lot of the risk off the table, and it also still has some growth potential ahead of it as it continues to try to grow its distribution in line with its distributable cash flow per unit growth profile. So when you add all those things up, there's an argument that can be made for valuation multiple expansion as well, given how high the yield is. And so when you add all those things up, we're looking at mid-teens potential annualized total returns, maybe even higher, at least in the short term, while the valuation may reprice, especially if interest rates come down. It makes the bond-like cash flows of the pipelines even more attractive. So again, I think DKL, if you're looking for a big yield, it's one of the lower risk ones that are that high. Again, it's no yield that high is low risk, but it's on the lower end of the risk spectrum for such high yields. Now, what is the high yield stock that I'm going to rate to sell today? Well, it's NextEra Energy Partners, and this shouldn't be any surprise to you. I've discussed it in previous videos, and it has an incredibly high yield. I think I just saw today it's gone up to now about 20% is its distribution yield, and believe it or not, that is fully covered by cash available for distributions. So it is generating a very high CAFD yield. However, it has a very weak balance sheet. It has enormous equity and debt obligations coming due in the coming years. And interest rates are high as equity valuation is beaten down. And so something has to give. Its coverage ratio is very thin. It is covering its distribution, but it has very little retained CAFD. And so when you add all those things up, along with the fact that its leverage metrics are bumping up against the downgrade level, they're not at a risk of a downgrade, but they don't have a lot of additional capacity they can take on. So when you add all those things up, it's probably going to have to really slash its distribution. In fact, in its recent earnings call, management even alluded to this. They talked about how they're going to have to reconsider their capital allocation framework, including potentially their distribution policy, talked about how they might want to retain more cash flow in the partnership in order to fund its growth obligations and deal with its upcoming equity and debt obligations with internally generated cash flow to avoid having to do majorly dilutive equity issuances. Because again, the manager, the parent is NextEra Energy, and they have a large equity stake in NEP. And so they're wanting to protect that investment. They don't want to just dilute it away with equity issuances. And so I think that's where they're probably going to lean. They may still have to do a bunch of additional asset sales or other creative equity capital raises to deal with these things because they're just so huge, the upcoming equity and debt obligations, especially if interest rates remain elevated. But I think at a minimum, they're going to slash the distribution pretty heavily. And so that's the reason why I'm staying clear of it, because there's just too much uncertainty. The balance sheet is too heavily leveraged. The cut is likely going to be quite steep, and it's hard to see how there's a lot of upside potential, at least in the near term, with NEP, especially because on an EV to EBITDA basis, which is a common valuation metric for this sector, it really is not that attractive. And so I just don't see much there that draws me to buy the stock right now. And so for those reasons, I rated it a sell, albeit I'm not shorting the stock because, again, it's been beaten down. The yield is so high. So I just kind of view it as an avoid. But again, I'm definitely not bullish on it, and there are other renewable yield codes I like a lot more, like Brookfield Renewable Partners is one I've mentioned. Clearway Energy is another one that I like a lot right now. In fact, I just bought some shares recently. So anyway, hopefully this video was helpful for you. Hopefully it gives you a greater perspective on just because a stock has a double-digit yield does not mean run for the exit, but it does mean be cautious and look carefully at the balance sheet, at the coverage ratio, at the business model, at management strategy, how committed they are to the distribution, things like that. And you can find some real gems. You can really juice your income stream if you find the good ones, and you can avoid a lot of pain and a lot of loss and expensive lessons if you can avoid the highly risky ones like NEP. Thank you very much. See you next time.